Welcome again to another investment analysis video. This time I would like to see and be sure that you understand why a risk-averse investor would be willing to take a risky investment. Okay? You might think that they would never do that, but of course they do in the real world. Let's see why. Okay, so in this example that we've seen, we have utility wealth function of 15 times the natural log of wealth. Start off with 50,000 and a risk appears that has this RDOPO, risky distribution of possible outcomes, and we see that as a consequence of this risk appearing, our expected utility becomes 158.73, which is certainly less than 162.297, and we're worse off. So we've been looking at this again as a risk appearing after markets close. Now let's look at it as follows. We have cash in our brokerage account, and we haven't taken a position in a risky asset like stocks or ETFs, and you're thinking about doing so. So the issue is having a certain amount of cash, say $50,000, invested in the risk-free asset might give you utility of a number of utils rather of 162.297, a way of, artificially quantifying utility or satisfaction or happiness. And you might now think that, well, you're contemplating taking or making an investment in something that has this risky distribution of possible outcomes. We're assuming we know it before the fact, before we invest our money. And then the idea here is, well, if this is our expectations of the probabilities, and these are our expectations of terminal wealth, given that we started with 50, then when we see our expected utility, given that our DOPO is 158.73, less than 162.297, then we would choose to not make that investment. Okay? So when we're looking forward, we will decide, and this is important to understand, we will decide to make an investment if we're risk averse when the expected utility associated with the investment exceeds the utility associated with our current investment. Okay? And it's very comfortable to always think about the current investment being an investment in cash, where you have something like a treasury security where your return is in nominal terms is guaranteed. Okay, so in this case we don't want it. This risky distribution of possible outcome takes us from utility of 162.297 down to 158. But even leaving these probabilities the same, we can make this look a little better. I'll change the 0.2 probability, which currently has a $50,000 wealth outcome. I'll change that value to 80,000 for wealth, and then I'll change the 70,000 value of wealth associated with a 10% probability to 130,000. Okay, so now we look at it. Is that enough to make this a go? Well, we had 162. This leaves us with 161. Still not good enough. All right, let's, just to make something up, let's change this 80 to 120,000. So a 20% chance of the 50,000 growing to 120,000. Okay, quite interesting because it's still not quite enough. We had utility originally of 162.29. This leaves us with utility of 162.28. Okay, well, let's assume now that the worst case outcome, instead of being 30,000, suddenly becomes 39,000. Okay, and if this is our new risky distribution of possible outcomes, Again, 40% chance of our wealth becoming 39,000 from the 50, 30% chance 40,000 terminal wealth, 20% chance 120,000 terminal wealth, 10% chance 130,000 terminal wealth, and then assuming this is our utility wealth function, then our expected utility given this RDOPO now is greater than what it had been, 162.29. In fact, it's 163.86. And so now you could make the argument that this investor could rationally choose to accept this investment. And again, the reasoning for that is because the original utility of wealth was 162.297, and then the expected utility of wealth given this RDOPO based upon these probabilities and these terminal wealth assumptions was 163.86, which of course once again is larger than 162.297. Okay, so that is an important thing to consider. And again, that is that risk-averse investors will rationally choose to make an investment in a risky asset when the expected utility associated with making that risky investment exceeds the expected utility or current utility of another low risk or zero risk alternative. That's all I have. Thanks for watching.